One of the key questions for US investors right now is whether or not US growth has started to show signs of slowing. Furthermore, if they are slowing, are the signs so serious that US stocks are poised to potentially take another leg lower if the Fed are having to hike more than 7 times this year? Now, ultimately, that question of slowing US growth will be answered as more and more US economic data comes in and the picture becomes clearer. However, it is worth looking at stocks that tend to do well as interest rates rise, like American Express. Remember that stocks and interest rates can actually rise together as long as growth stays on track. And financials can also potentially gain as their higher interest rate charges can mean higher profitability. So between March the 30th and April the 28th, over the last 14 years, American Express has risen 11 times with an average return of over 4.5%. So will American Express rise again this year during this period, or will signs of slowing US growth harm the outlook for financial stock? Remember, you can analyze these charts for yourself by going to seasonax.com and get a no strings attached 3-day free trial. Why don't you see all the different patterns that are out there? It's a great opportunity to take advantage of using SeasonX. Remember, don't just trade it, SeasonX it. Major trade risks. If US growth does show signs of slowing, but the Fed still has to hike aggressively to contain high inflation, that results in a stagflationary environment that tends to give financial stocks like American Express a poor outlook. So that needs to be borne in mind as a key major trade risk.